The stock market. It's unpredictable, sometimes volatile, and one thing we know for sure is that it moves in cycles. A crash is inevitable, and while we can't say exactly when, being prepared is the key to surviving when it happens. So, what's the secret to staying calm and even growing your wealth during a market crash? Let's take a page from the book of Warren Buffett, one of the greatest investors of all time. Buffett doesn't try to predict the market, but his strategy for weathering downturns and ironically making a profit off of it is something we can all learn from. In this video, I will show you 4 key strategies Warren Buffett is using in 2024 to prepare for potential market volatility. With today's high inflation, rising interest rates, and global uncertainty, these lessons are more relevant than ever. So what exactly is Buffett doing to safeguard his wealth in such an unpredictable environment? Let's start with the first key strategy, holding cash reserves. One of the things Warren Buffett is known for is his huge cash reserves. In 2024, this strategy is more relevant than ever, especially with market valuations sky high and economic uncertainty looming large. Now, Buffett isn't just sitting on this cash for no reason. There's a method to his madness. As of today, Berkshire Hathaway is sitting on billions of dollars in cash and short-term treasuries. In fact, Berkshire is holding around $276 billion in cash, despite the fact that he's always on the lookout for great investments. So why is one of the world's greatest investors so cautious? It's simple. Buffett knows that during times of economic turbulence, cash is king. He's holding on to this cash as a safety net, not just for his company, but also to take advantage of opportunities when stock prices drop. Buffett has famously said, the best time to buy is when there's blood in the streets. He's waiting for the market to hand him a golden opportunity. When prices drop, he's ready to strike. And why does this matter in 2024? Inflation is still sky high, interest rates are rising, and market valuations are inflated. So why is this important in 2024? The economic environment has been turbulent. Rising inflation, higher interest rates, overvalued stocks, they make finding quality investments challenging. Rather than overpaying for companies, Buffett prefers to wait, knowing that the ripe opportunities will come when the market corrects. It's a lesson in patience and discipline that all investors can learn from. Buffett's philosophy is clear. Cash is not just a reserve, it's a strategic tool. He wants to be ready to act when great companies become undervalued during market downturns. Buffett has often said that the best time to buy is when there's blood in the streets, and he's positioned Berkshire Hathaway to make significant moves when that time comes. Today, many stocks remain overvalued, and Buffett's choice to hold cash is particularly smart. He doesn't feel pressured to deploy it just because the money is sitting there. Instead, he's waiting for the market to give him a pitch he can't refuse. A great business at a bargain price. The takeaway here is patience. As an investor, you don't need to swing at every pitch, just like Buffett. Having cash on hand allows you to act when the time is right, and market corrections offer prime buying opportunities. If you're holding some of your portfolio in cash, you'll be able to snap up quality stocks at discounted prices when others are panicking. Remember, cash is power when markets are volatile. Now, that doesn't mean you should keep all your money in cash. Buffett himself has said he'd prefer to invest in great businesses if the prices were right. But in today's inflated market, where many stocks are trading at lofty valuations, keeping some money on the sidelines is the smart move. As an investor, you don't have to sit on billions, but keeping a portion of your portfolio in cash or short-term securities can be a great way to prepare for the next market downturn. When the market drops, and it will, you'll have the dry powder to jump in and buy great businesses at discounted prices. But holding cash is just one part of the equation. To truly protect your portfolio, you also need to avoid one of the biggest traps: borrowing money to invest. Another key principle Warren Buffett follows, and advises everyone to do the same, is avoiding margin debt. Buffett has been crystal clear about this throughout his career. Borrowing money to invest in the stock market is a recipe for disaster, especially during uncertain times. And in 2024, with interest rates rising and market volatility on the horizon, this advice is more critical than ever. Using margin debt means borrowing money to buy stocks, which can seem like a good idea when markets are going up, but the problem comes when those same markets drop. You see, if the stocks you bought from borrowed money fall, you'll face what's known as a margin call, where you're forced to sell your investments at a loss to repay the debt. It's a financial squeeze that can turn a bad situation into a disaster very quickly. Buffett once said, "It's insane to risk what you have and need for something you don't need." And this couldn't be more true when it comes to borrowing to invest. On another occasion, Buffett said, "The one thing I would advise is never borrow money to invest in stocks. I've seen more people get into trouble that way. You don't want to be forced out of a great position because of short-term fluctuations." This is a critical lesson for all investors, especially in 2024. Markets are unpredictable, and when stocks fall fast, as they did in October 1987, or more recently with the 2020 COVID-19 crash, those who have borrowed money were forced to sell their stocks at the worst possible time. This is called the margin call, and it's every investor's nightmare. If the value of your investment falls, and you can't meet the margin requirements, you're forced to sell at a loss. In 2024, with rising interest rates and this market volatility, borrowing to invest is more dangerous than ever. Buffett's wisdom here is that you simply can't predict what will happen in the market tomorrow, and the risk of being forced to sell a good investment at the wrong time is too great. It's not worth risking what you have and need for something you don't truly need. While avoiding margin debt helps you protect your investments, there is another major pitfall to steer clear of: speculative investments. Warren Buffett is famously known for avoiding speculative investments, and with so many options popping up lately, this advice is as relevant as ever. Speculative investments, whether it's cryptocurrencies, meme stocks, or highly volatile tech stocks, may promise big returns, but they come with a great deal of risk, especially when the market faces uncertainty, and we've seen plenty of that in recent years. Buffett has never been one to chase after the latest hot investment. His approach is rooted in investing in real, productive businesses that generate cash and have strong long-term prospects. In his own words, when you buy a business, you should look at what it produces, not what someone else will pay you for it later. Speculation is all about hoping someone else will buy the asset for a higher price, but there's no underlying value being created. This is a critical distinction between investing and speculation. When you invest in a productive business, like the companies Buffett owns through Berkshire Hathaway, Apple, Coca-Cola, or American Express, you're not just betting that someone will pay you more for the stock. You're investing in the actual value the company creates through its products and services. Over time, these businesses grow and produce profits, which increase the value of your investment. In contrast, speculative investments don't produce anything. Cryptocurrencies, for example, rely solely on the belief that someone else will pay a higher price. There's no underlying business, no product, no earnings, just speculation. This makes these kinds of assets extremely volatile and high risk, especially during market downturns. In 2024, we've seen massive fluctuations in the value of speculative assets like cryptocurrencies and certain high-flying tech stocks. Many investors have suffered huge losses when these assets crashed, proving once again that speculation is a dangerous game. The takeaway for you? The lesson is clear: stick to productive investments. Avoid chasing the next hot trend or investing in assets that don't produce anything. Instead, focus on buying companies that generate cash, grow over time, and have a solid business model. In the long run, these investments will provide more stable and consistent returns even if their stock prices fluctuate in the short term. Buffett's strategy is simple: invest in what you understand and ensure it produces something valuable. Speculation may be tempting, but it's a gamble that rarely pays off. By sticking to productive assets, you're not just betting on price movements, but on the ability of a business to create wealth over time. If there's one thing Warren Buffett consistently emphasizes, it's the importance of investing in high-quality businesses. No matter what the market is doing, whether it's booming or crashing, Buffett sticks to his principle. He looks for companies with a strong competitive advantage, excellent management, and consistent cash flow. And in 2024, this strategy has never been more important. Buffett has always said that the best way to protect your portfolio during a downturn is to make sure it's filled with great businesses. These are companies that have proven that they can thrive even in tough times. They might take a hit during a crash, but because they have strong fundamentals, they're more likely to recover and continue growing over the long term. Like Buffett once said, if you own great businesses, you don't have to worry about what the market is doing every day. In the short term, the market is a voting machine, but in the long term, it's a weighing machine. So what does a high-quality business look like? Buffett points to three main factors: competitive advantage, competent management, and consistent cash flow. In simple words, the company has a moat, something that predicts it from competition, whether that's a strong brand, patented technology, or efficient operations. The people running the company are skilled, ethical, and focused on creating long-term value. And the business generates steady and reliable cash flows, even during tough economic periods. In 2024, with inflation, rising interest rates, geopolitical uncertainty, and this volatile market, these kinds of businesses become even more valuable. Companies with strong moats and robust cash flows are better positioned to weather economic downturns, while speculative or debt-laden companies are more vulnerable. Let's look at a few companies Buffett continues to hold in 2024. Giants like Apple, Coca-Cola, and American Express. These businesses have stood the test of time. Apple, for instance, dominates the smartphone market and continues to innovate. Coca-Cola has been a global brand leader for decades. And American Express benefits from strong brand loyalty and global financial networks. Even during economic downturns, these companies have the strength to pull through because they have a solid foundation. In tough economic times, high-quality businesses tend to have a few key advantages. First, they're less likely to go bankrupt. Their strong balance sheets and reliable cash flows give them the stability to survive downturns. Second, they're more likely to attract long-term investors who believe in their value, which helps to support their stock price even when the markets are shaky. And third, they offer opportunities. When the market crashes and the price of high-quality companies drop, that's when you can buy these great businesses at a discount. So how can you apply this to your own portfolio? First, review the companies you've invested in. Are they businesses with strong fundamentals, or are they more speculative? Focus on building a portfolio of companies with a solid competitive advantage, strong management, and consistent cash flow. You don't need to worry about the daily fluctuations in stock prices if you're confident in the long-term value of the companies you own. This is one of the reasons Buffett does not try to time the market. Instead, he buys businesses he believes in and he holds on to them, knowing that over time their value will increase. In 2024, we're seeing more and more investors chase speculative gains or panicking when the market dips. But as Warren says, buy quality, hold quality, and don't worry about the short-term noise. The best way to prepare for a market crash is just make sure you're invested in companies that will not only survive a downturn, but will thrive in the long term. The biggest takeaway from Buffett's strategy is that the high-quality businesses provide a safety net during market crashes. They may take a hit like everything else, but they'll recover, and over time, they'll likely emerge even stronger. Want to know about these super undervalued Chinese stocks under Warren Buffett's value principle? Click the video to find out.